Dark clouds are looming over HSBC. It's revised the value of its brand down by more than $7 billion because of lower growth expectations in its largest market, Europe. Many of its branches in Hong Kong have faced frequent closures over the past year because of protests. And now the bank's most profitable market, China, is also sputtering due to the coronavirus outbreak. The bank's acting CEO issued this warning.
There is the potential for any associated economic slowdown to impact our expected credit losses in Hong Kong and mainland China. Longer term, it is also possible that we may see revenue reductions from lower lending and transaction volumes, and further credit losses stemming from disruption to customer supply chains.
HSBC is hoping to weather this storm with a major restructuring. It's laying off 35,000 workers over the next 3 years, about 15% of its workforce. The bank hopes these layoffs will save it $4.5 billion. And it's selling off assets worth $100 billion as it winds down investment banking services in the US and Europe.
They are not producing that much because, as I've said, the revenue side actually would be very difficult. And I think they would like to maintain the sales force as well. And the back office actually would be the first one to go already. So there are not much to go now.
The restructuring could hit London's financial industry the hardest, which has already seen major job cuts from Deutsche Bank and Nomura Securities. And with growth stalling in many Asian economies, analysts are warning of more pain for HSBC and other banks. Mobin Nasir, TRT World.
And Mobin joins us here now in the studio for more on the story. Hi Mobin, what more can you tell us about this rather radical downsizing plan? Which of HSBC's businesses will be most affected?
Well, if the $7 billion write-off is indicative of the bank's future in Europe, right, or lack thereof, we know that investment banking is an area where they've struggled, particularly with their margins. It's not that there isn't business out there. Rather, it's just not profitable. What we have been hearing over the past year is that we know that they've already sacked a whole lot of people or made a lot of jobs redundant in their back offices. So there's probably not a whole lot of room left there. Having said that, there will, of course, be more crunching in terms of getting rid of many offices and perhaps merging businesses, primarily on the investment banking side. But as far as their US business goes, the bank has revealed that they will be cutting that down, the retail side, by about a third. So really, this means that effectively the only areas that the bank is looking at growth in are in Asia, particularly in China, which is perhaps also why their warnings over the slowdown there are making things even worse for them going down the road, in essence saying that all the troubles are not over yet.
You mentioned in your story that the number of truly global investment banks is dwindling. Why is it becoming such a hard business to stay in and do well in?
I think, so let's just go back to this bank's performance just to be able to illustrate that, right? In 2017, they had over $100 billion invested in risk-weighted assets, and they made just $176 million on that. Of course, that's in terms of the kind of returns that investors are looking for, or investors in the bank are looking for, really, that just doesn't cut it. So, and what has happened is, of course, there's the low interest rates that are squeezing margins, but a lot of other things have also been driving up costs for the banks, like compliance. We've seen massive fines being imposed on some of these banks, particularly in the EU. We know that cost of the KYC, as it's called, know your client, compliance costs in those terms have been rising. And so really these are the things that are muscling the banks out slowly but surely. And we're coming to a situation where only the biggest of the big banks, i.e. the US banks, who are able to sort of cushion their other businesses simply by the scale of their retail operations. So really we're coming to a situation where they are the only banks who seem to have enough gunpowder to ride through this.
Interesting. So is that related to the idea you mentioned earlier that banks like HSBC are being driven out of the US retail market?
Yeah, and it's not just the big banks that are driving them out, right? Look, we've seen the rise of fintech. That's replacing a lot of areas that conventionally people would go to banks for advice. Then you're seeing a lot of projects also just cutting the banks out altogether, and pension funds or targeted infrastructure funds or sovereign wealth funds. We've been hearing more and more about their direct investments into large-scale projects. So effectively, these are also cutting the banks out. And if the bank can't make fees, it can't charge commissions, really a lot of those revenue streams are drying up, and hence banks finding themselves in a position where it seems like they are going to be a more plain vanilla lending and deposits model primarily.
Okay, well, let's see how HSBC decides to roll this downsizing plan out. Mobin, thank you as always.